This is the second half, video 2 of chapter 8. It's accounting for receivables. So the sum of the estimated uncollectible accounts for each age class is estimated uncollectible accounts on December 31. This is the desired adjusted balance for allowances for doubtful accounts. Comparing the sum of the estimated uncollectible accounts in the aging schedule with the unadjusted balance of the allowance account determines the amount of the adjustment for bad debt expense. So here's an analysis. Here's our bad debt expense for 23,240. The numbers are right here as well. Here the balance 3250, 2324. So 26 minus the 32 gives us that 23,240. So 23,240 is going to be debited, and our allowance for doubtful accounts is going to be 23,240. Don't forget, this automatically goes to, anytime we see an expense, it always goes to our income statement. So this one is going to be the contra asset, allowance for doubtful accounts. And don't forget, as we deplete this, it also takes away from our account receivable, okay, because it's a contra asset. So here's the analysis. The bad debt expense adjusting entry is 23,240. The balance will be 23,240. Unadjusted balance is going to be 3250. Adjusting entry, which we just talked about, of the 23,240. So unadjusted balance of 26,490. Okay, so that's what it would look like. This is for our expense account, and this is for our contra asset account. Okay, so that's what that's showing. So here's another example. Account receivable of 800,000 debited. Allowance for doubtful account is 7,500 for a credit. Okay, so the company recorded 3.5 million of credit sales during the year. So let's take a look at that. So here's what it looks like. Not past due is 658,000. 1% 1 to 30 days is 6,900 or 69,000, which is 6%. 31 to 90 days is 47,000 or 14%. Over 90 days is 26,000, and that's 20%. So the total equals 800,000. So here's what it's asking. So we'll go through and take a look at these three items, A, B, and C. So A, we're going to record it to 22,500 minus 7,500, which we're going to have a $15,000 bad debt expense, and then our allowance for doubtful account right here. Okay. Again, how we got that was we had 22,500 subtracted the 7,500, and then that's where we arrived at 15,000, because that was adjusting entry we needed to make. Okay, so there's part B right there, adjusting entry, and there's arrows. This is also in your textbook. So in our account receivable was $800,000 balance. So, and then on our, so right here at the bottom component C, accounts receivable is 800,000 minus doubtful accounts is 22,500. So our net realizable value of the account receivable is $770,500. And all you do is you take your account receivable minus your doubtful accounts, and that's your net realizable value, which we talked about in chapter, or in the video 1. Okay. So difference between estimate methods. So percent of sales versus analysis of receivables. So 22,500 versus 23,240. So these are some things to take into account whenever you look at which method would be more accurate. That's up to you. I think if you take the analysis of receivables, you have a lower expense up there. If you have a percent of sales method, it is higher. No, actually it's lower. But those are things you need to take account which one you would go with. Obviously, this one would be more favorable on your expenses. It decreases your net income, but keep in mind your net income is what you pay taxes on. Okay. Now that one's lower, so it just depends. Earlier we did an analysis of the impact of expenses on the income statement and the balance sheet. So for tax purposes, more than likely you're going to go with a higher expense, I guess percentage or rate, or a higher expense number, which would be the analysis of receivables method. But it depends. Also, just suggest don't be switching back and forth. If you go with one method, stay with that method. Okay, so if you switch back and forth, then the IRS freaks out. Also, your auditor will freak out and be like, well, you need to stick with one. So keep in mind that those are some important things that you need to take into account whenever you choose a method. But typically, here's the thing. This only happens if you have a lot of accounts receivable, like hundreds of accounts receivable, hundreds of customers, and hundreds of, just notes receivable as well. So keep that in mind. So comparing direct write-off and allowance. So here's what this looks like. Here's the situation. Jason Big, not Jason Biggs, has $1,100. Steve Bradley, $2,220. Samantha Neely, $775. Sanford Noonan, $1,360. Aiden Wyman, $990. So these are examples, okay? So $340 million, $3.4 million of credit sales. 1.25 of credit sales are expected to be uncollectible. So this is important information. There's other information up here as well, but we'll take a look at that here. Okay, so our bad debt expense, $36.50, is going to be written off for York. We're also going to write off, I think in here, let's see, the partial payment. So then the remaining balance, $22.50 of cash and $32.5. So the total account receivable for Bradshaw was $550. So you all should know how to do this already because we've been working on this account receivable. So we're putting this bad debt expense, so we couldn't collect that at all. Okay. Let's see. So this one, we reversed it because we received money. See, I can look at this analysis already and see we reversed it. That's how proficient you all need to be at as well. Okay. So $36,500. So they finally paid us. So we got our money. Here's our bad debt expense account. Okay. And here's what we're pulling off of their books. Okay. And then there's no entry at the end. So this is direct write-off. Now here's the allowance method. So look at the compare and contrast. $36.50 was the same. Cash receivable was the same for Bradshaw. So we went here, we did reversal, which is exactly, okay, the only difference is, look at this, allowance for doubtful accounts. That's the difference there. Right here as well, allowance for doubtful accounts, okay? Cash, we did receive the cash, same as well. And then right here, the only difference is the direct write-off goes directly to the income statement. The allowance method goes into allowance for doubtful accounts, okay? So keep that in mind. It's not expensed out until, look, down here at the end. So those are some differences. So in a sense, you're kind of collecting them, and then actually you're collecting them and putting into allowance for doubtful accounts. So keep that in mind. So this is done as you go through the month. This is done at the end of the month, or at the end of, yeah, it actually is typically done at the end of the month. Sometimes, you don't want it to, get too high, okay? And again, they look very much the same, except that says expense. This one says doubtful accounts. Now we bad debt expenses, so $42,500 is then written off onto our income statement, and then allowance for doubtful accounts, okay? And here's where that 1.25% comes in, right there, of the 3.4 million. So here's a little chart table that shows the differences. You can go through and look at this. Allowance account, no allowance account is used. Allowance account is used for allowance method, and we just looked at them. Small companies and few account receivables, just do them as a direct write-off. If you have a large company with a lot of account receivables, go with the allowance method, because what happens, it becomes really tedious if you do the direct write-off method if you have a lot of account receivables. So it's a simpler way of taking account your doubtful accounts, or your accounts that get written off as uncollectible. Note receivable. A note receivable has some advantages over account receivable. By signing a note, the debtor recognizes the debt and agrees to pay it according to its terms. Thus, a note is a stronger legal claim. A promissory note is a written promise to pay the face amount, usually with interest, on demand or at a date in the future. Characteristics of a promissory note are as follows. The maker is the party making the promise. The payee is the party whom the note is payable. The face amount is the amount for which the note is written on its face. The issuance date is the date a note is issued. The due date or maturity date is the date the note is to be paid. The term of a note is the amount of time between the issuance and the due dates. The interest rate is the rate of interest that must be paid on the face amount for the term of the note. So here's an example. All of those different components are on there. It goes 1 through 7. So 1 through 7, just like that. Here's the actual visual of it. And I need to see a visual. So I know that the prior slide was a bunch of text. I'm not really good at reading a bunch of text, but if I see something, I understand it more clearly. So, but everyone has a different learning style. So here's an example of a promissory note. Okay. All right. This is also in your textbook or your online ebook. So here we go. Characteristics of a note receivable. Days in, 31 days. Minus issuance date, 16 days. Days remaining in March, 15 days. Days in April, 30. Add days in May, 31. Add days in June. Due on the 14th, it'll be 14 days. So the term of the note is 90 days. Okay. So keep in mind how to do this. This is important. It's also important to have a calendar whenever you do this as well, because some days have 28 days, some days have 30 days, some days have 31 days. So just keep that in mind. Determining due date of the promissory note. So there's 15 days here, 30 days in April, 31 days in May, 14 days in June. So this is a way to figure it out. Okay. This is when you issued it on March 16th, and when it's due is June 14th. Another visual of how this would look. Characteristics of a note receivable. The interest on the note is computed as follows. Face amount times interest rate times term divided by 360 days, because we're trying to get a fraction of the year that it is being, extending the note. So 2,000 times 10%, or this on your calculator would be 0.10 times 90 divided by 360, which will equal $50, okay? And that's all I was saying. So the maturity value is the amount that must be paid at the due date of the note. Let me have a drink of my coffee really quick. Okay. So total that would be due would be $22,050, because the $50 is the actual interest that we charge on that note receivable. A promissory note may be received by a company from a customer to replace an account receivable. In such cases, the promissory note is recorded as a note receivable. Okay, so here's an example. So $6,000, 30-day, 12% note. So note receivable, we're putting this on the books for Bunco. So $6,000. So keep in mind, we had an account receivable for them, but they didn't pay it. So we're moving it to note payable. So the interest rate, we're adding interest because we're carrying it longer than 30 days. So this is getting moved out of account receivable, but we're moving into a note receivable. So we're debiting the note receivable account, and we're the receivable account, we're decreasing it, or we're zeroing it out. That's what that's showing right there. All right, so here's what happens at the due date. So they come and pay. They pay us $660, 6,000 times 12% times 30 out of 60, 360. So that'll be $60. So that's how we get the 660. So the principal plus interest. So this is principal plus interest right there. Okay, so our interest revenue goes at $60. Don't forget, our revenue goes straight to our income statement as well as revenue. Okay, so now our note receivable is being zeroed out. This we zeroed out because on the previous slide we created this note receivable. So now we're saying, oh, they paid it, so we received cash of $6,060. Okay, so if the marker of the note fails to pay, or the maker of the note fails to pay the note on the due date, it is considered a dishonored note receivable. A company that holds a dishonored note transfers the face amount of the note plus any interest due back to the account receivable. Notice if it goes out of that period, that length of time that we wrote the note for, once it reaches its maturity date, I'll use the actual terms, then we transfer it back into account receivable. Okay, so then it goes back in there. So they plus interest. Okay, so here's what happens. So they went past they went past the date. So 6,000, 30-day, 12% note. So it goes back into account receivable, 660, note receivable, 6,000. So what we did is we took it out, but we put it back in there. We still put our interest revenue. Okay, we still got that. Okay. And let's see, a company receiving a note should record an adjusting entry for any accrued interest at the end of the period. So here's what this looks like. So again, note receivable, 4,000. This is a different one. 90-day note, 12% interest receivable of $40 interest revenue, $40. So here's our interest, how we got it, 4,000 times 0.12 times 30 divided by 360. And yep, okay. All right, so then, so on March 1, the company receives $41.20 face amount plus 120 interest from Crawford. Okay, so then cash of $41.20, receivable. So this is the principal of it plus interest receivable plus our new interest revenue. So that we combine those two to get the 120. So total interest. Okay. And typically, by the way, if you pass your note receivable, typically what would happen is they would increase your interest rate because you're renegotiating the terms of your note receivable, okay? Icebreaker Company received a 120-day 6% note for $40,000 dated March 14 and settlement of an account that is past due. The balance of the account is $40,000 determined. So A, B, C are the different components. Let's take a look at this. So here's what happens. So first thing we're going to do is we're going to calculate it. May 14. 17 days plus 30 plus 31 plus 31 plus 11 days. So then now we're at the due date of March or September 11. Okay, so we're going to go 40,000 times 6%. 120 divided by 360. So our interest is going to be $800. So our maturity value at when the note is done is $40,800. So next we're going to record. That's, by the way, that's component B. C says journalize this, notes receivable 40,000, account receivable. So we're pulling it out of account receivable and we're moving into note receivable. September 11, maturity date, so 40,800 cash received, note receivable. So we're clearing it out of that note receivable right there. All right, and we're recognizing an interest revenue of $800. Don't forget that goes straight to our income statement, okay? Let's see, so reporting receivables on the balance sheet. So this is what it would look like. Our current assets, cash and cash equivalents, $250,470. Account receivables, net. Keep in mind, net means that's the account receivable minus our allowance for doubtful accounts. So $622,685. Okay. All right, moving on. Let's see. Oh, note to financial statement. There'll be a note on there as well, and you'll just explain what that is. The account receivable turnover measures how frequently during the year the accounts receivable are being converted to cash. The accounts receivable turnover is computed as follows. Sales divided by average accounts receivable. So here's our sales for, this is probably abbreviated. Oh, it says in millions. So 4.825 million and 3.936 million. So beginning of year 434 and beginning of the year 280. End of year 623 and 434. So then we go 39, 633, 280 to plus 4. So we're averaging, by the way, divided by 2. So we get 11.1. And down here we get 9.1. Notice these dollar amounts come from right here. Okay. And our turnover for year 2 is going to be 9.1. So but yeah, this is what it looks like. So your turnover is 9.1, and for year 1 is 11.1. Okay. Let's see. Next is number of days sales and receivable is an estimate length of time the account receivable has been outstanding. The number of days sales and receivable is computed as follows: average account receivable divided by average sales. Okay, average daily sales. So same thing, $357 divided by 39 divided by 39.6 divided by 365. So 357 divided by $10.90, so 32.8. Year 2, 528.50 divided by 4825 divided by 360, because this is, we're trying to figure out how many, the dollar amount in each day. So average is $13.20. So we divide 528.50 divided by 1320 and we get 40.0. So that's the number of days in sales receivable. Okay. All right, so here's what this looks like. Account receivable turnover 11.1 to 6.5, so we did see it, and we did notice an increase there. Okay, number of days in sales, so it did go up. So keep this in mind. I mean, obviously, if you deal with account receivable and you deal with a lot of inventory, this will make a difference. So this is just account receivable. Okay, so that finalizes chapter 8, receivables chapter. If you have any questions, please email. Make sure you complete the discussion questions and the homework. Homework is due usually Monday nights, midnight. So make sure you get your work done. Thanks. Have a good day.